Hello everyone, my name is Gunjan Mundale, and in this video we are going to understand what is hedge fund and how it works in India. So let's start with what is hedge fund. Hedge fund is a private investment partnership and funds pool that uses varied and complex proprietary strategies and invests or trades in complex products including listed and unlisted derivatives. Simply, a hedge fund is a pool of money that takes both short and long positions, buys and sells equities, initiates arbitrage, and trades bonds, currencies, convertible securities, commodities, derivatives, products to generate returns. It reduces risk as the name suggests. The fund tries to hedge risk to investors' capital against market volatility by employing alternative investment approaches. Description: hedge fund investors typically include high net worth individuals and families, endowments and pension funds, insurance companies, and banks. These funds work either as private investment partnerships or offshore investment corporations. They are not required to be registered with the securities markets regulator and are not subject to the reporting requirements, including periodic disclosure of NAVs. Now we understand how does a hedge fund works. In India, accredited investors who have annual income at least 2 crore and have net worth 7.50 crore are called accredited investors. They pool their money in hedge fund and then hedge fund manager invests all the investors' money in different investment tools, currencies, etc. Hedge fund manager charges 2% of the asset of the investors in the form of management fee and 20% of the profit which was generated by a hedge fund manager in the form of performance fee. Now we understand what is hedge fund structure. They are typically only available to qualified or accredited investors who have annual income at least 2 crore and net worth at least 7.50 crore. They have a wide spread of investments to include stocks, bonds, and mutual funds, but can also invest in real estate, food, currency, art, or whatever the fund's goal can encompass. They frequently leverage other funds like borrowed money to attempt to increase return, which can increase risk but also increase returns. They have a 2 and 20 fee structure where an expense ratio and a performance fee are charged. Now, what is a 2 and 20? Most hedge funds operate on a 2 and 20 manager compensation scheme, which gives the hedge fund manager 2% of the assets and an incentive fee of 20% of the profit every year. However, this structure has widely been criticized given that even if the hedge fund loses money that year on the profits, the fund manager still makes a cozy amount from that 2% of the invested assets. Features of hedge fund: accredited investors, wide investment latitude, uses leverage, risk factor, fee structure, tax obligation, and no regulation. Let's learn this feature in broader way. Features: accredited investor. An ordinary investor cannot invest in hedge funds. Only qualified or accredited investors like banks, insurance companies, and even high net worth individuals are allowed to invest in such funds. Wide investment latitude. The hedge funds cover almost all kind of asset classes including stock, bonds, real estate, currencies, equities, derivatives, etc. Uses leverage. The fund which are invested as hedge fund are usually the borrowed sum in the hands of the fund manager. Risk factor. Some of the hedge funds are exposed to a high risk which may lead to huge losses. The lock-in period is comparatively very high regarding other investment options. Tax obligation. The hedge fund is not exempted from tax and is taxable on the grounds of the level of investment. This tax will not be borne by the unit holders. No regulations. These funds are not registered and do not lie under the regulations of the securities market regulators. Fee structure. The fees of the hedge fund managers are 2 and 20. 2% is the fixed fees, whereas the manager takes 20% on. Mutual fund and hedge funds are considered same, but there are some difference between mutual fund and hedge funds. Mutual funds don't take share from the profit. Hedge funds take 20% performance fee from the profit. Mutual funds are available to the general public. Hedge funds are available only to high net worth and sophisticated investors. Mutual funds charge a management fee, normally 1 to 2%. Hedge funds charge fee, normally 2% plus performance fee, normally 10 to 30%. Mutual funds can make high risk investments. Hedge funds can make high risk investments. Mutual funds tend to perform worse than hedge funds. Hedge funds tend to perform better than mutual funds. Mutual funds cannot do short selling. In hedge funds, short selling permitted.
Thank you.